and thank you all for joining us today. This Financial Poise webinar, Executive Compensation, is part of the Corporate and Regulatory Compliance Bootcamp 2025. Slide 7 of the PowerPoint summarizes this episode, and slides 8 and 9 summarize the series. Please look at those at your convenience. Speaking of the slides, while they're there as a tool, and we may have various slides up during the presentation by our esteemed panel, we're not going to step through the PowerPoint slides in order, nor will you have to listen to us read any slides. This webinar, like all Financial Poise webinars, is a conversation amongst the panelists, and so sit tight and listen for the next 60 minutes. We have a lot of questions that we're going to cover on this important topic. Keep the PowerPoint handy, however, because I'll try to indicate what slides our conversation is touching on as we proceed, so you can take notes. But again, I'm not going to be wedded to those. Some of the topics we'll cover may not be in a specific slide themselves. It's my pleasure today to have as our panelists Elizabeth Rickert, Andrea Powers, and Neil Lapley. My name is Dan Cotter. I'm with Ehrenberg Goldgen. We appreciate that you're spending your time and money to hear, not spending your time and money to hear infomercials. You can read more about us on slides 43 through 46 in the slide deck. This webinar is a production of Financial Poise. More about Financial Poise is on slide 48. If you are attending the live premiere of the webinar, you can submit questions as you were instructed earlier using our web portal. We'll look at that periodically throughout the session. If you have questions, you can please submit those and we'll cover those in addition to what we're covering. If you are watching this on demand or have any questions after the webinar, you can send an email to info@financialpoise.com. Remember, as slide 5 states, the PowerPoint and conversation we're about to have are meant for general educational purposes. Do not replace the need to consult with an attorney, accountant, or other appropriate professional for whatever legal needs you have, including on executive compensation. In other words, if you're silly enough to take significant action based upon what you learn here, don't blame us for your silliness. And I referred to this disclaimer kind of as the Michael Cohen rule, right? He said he had 3 clients that were legal. Everybody else, I don't know what he was doing, but it wasn't legal. We're not here to be your lawyers today, so don't expect that this is going to be general in nature. One last note, thank you to one of our sponsors, Max X Asset. More about the company and their promotional products is on slide 4. Okay, folks, we're ready to get down to business, and we're going to turn to asking questions right away. We're not going to talk about the summary or anything, and we're going to turn to Andrea for this first question. Andrea, there's a great deal of federal regulation of executive compensation in the current corporate climate. In a nutshell, why is executive compensation an important issue, and what led up to the executive compensation reform that has occurred over the last 15 to 20 years?
Well, thanks, Dan. Executive compensation, that is a term that covers a great many forms of compensation. So I think it's important that we understand what we're talking about before we get into sort of the history and the regulatory environment for it. Executive compensation, and at first blush, most everyone thinks it's some basic salary. It's exactly what the executive's getting on a paycheck every pay period. And while that's part of it, that cash compensation, there's a lot more to executive compensation. In fact, that term broadly includes everything from that cash compensation to deferred compensation. That's compensation that's paid at a later date, usually on separation from employment or retirement or some other future date where the services are performed, the compensation may be earned, but it's not paid until a later date and hopefully not taxable income to the executive until that later date. And then we come to equity, and everyone thinks equity. What do you mean by that? Well, that's everything from awards of stock, outright grants of stock awards, to restricted stock. That's usually stock that has either a vesting requirement or restrictions on the ability to sell or otherwise transfer the stock. stock options. That's where the executive has the right to purchase the stock at some specified price. Stock appreciation rights. Those are rights that give the executive a reward based on the appreciation in the value of the stock. Then we get beyond equity and we have things called phantom equity, which comes back to our deferred compensation frequently, which is where the executive is given a promise to pay the executive some amount based on the appreciation in the company stock. And then there are other less obvious forms of executive compensation that include all kinds of perks that we don't tend to get into, but memberships in certain clubs, automobile allowances, special benefits limited just to the executives, maybe an executive wellness program, or certain other types of benefits from work that apply only to those executives. And then finally, we also get to restrictive covenants that need to always be considered as part of the executive compensation package, which is those restrictions on the executive that make it fair for the company to provide the executive these higher salary and benefits. And these restrictive covenants can be things like non-compete agreements, confidentiality agreements, non-solicitation provisions where the executive can't leave and solicit any of the company's existing employees, customers, or potential customers. So all of this together is what we refer to broadly as executive compensation. And now to actually answer your question, what's led to this world of regulation that we have that really didn't exist? And I would say it's probably, we would have to go back now a little better than 20 years ago. We didn't have much regulation, but we have had over the past 20 years. Now, historically in this country, executive compensation was, for most employers, confidential. It wasn't shared. And then under the Securities Reporting Act requirements, compensation for certain executives has to be disclosed for publicly traded companies. And that compensation includes that very broad definition I just gave you. It's the cash compensation, the deferred compensation, the equity, the phantom equity, and even some of those restrictive covenants are subject to disclosures in SEC filings. But if you're a private company, that information is not required to be public. And unless there are corporate agreements requiring that information to be shared with other owners of the business, then that information is generally confidential. In a tax exempt employer circumstance, that information may not be as confidential, because if you're a tax exempt employer, you have to file an annual Form 990, and that requires providing compensation information for your top executives. So historically, this information was confidential, but again, over decades, that information has become less and less confidential and subject to more and more regulation. The primary form of regulation is coming from the Internal Revenue Code. And then secondly is from securities and reporting and disclosure rules. Why do we have it? Well, I think we would see that the most recent history on regulation of executive compensation comes from some corporate meltdowns that occurred in the early 2000s. Many of you listening to this may recall or have heard of Enron or WorldCom. And those companies had very public financial failures, leaving shareholders and employees with loss of investment and loss of job. And yet the perception was that the executives, or many of the executives from these companies, were able to leave employee and still get paid out some of their executive benefits, some of their executive retirement plans. And Congress reacted to that and reacted very strongly to that. The first piece of legislation that came out of that was the Sarbanes-Oxley Act. And we refer to that as the SOX Act, SOX, Sarbanes-Oxley. And that law implemented a lot of changes on the securities reporting and disclosure rules for executive compensation. And also out of that came the prohibition on employer loans to executives. So outside of very, very limited exceptions, such as for a general, like a 401k plan offering loans, employers that are subject to this law cannot offer any kind of loan or credit to their employees. So for example, exercising stock options now, it used to be that companies subject to this rule could lend their executives enough money to pay for the stock to exercise the option. And that became impermissible under the law change. But really, to me, the biggest changes all came about under the Internal Revenue Code. And the first, of course, is Code Section 409A that was adopted in October of 2004 and applies to deferred compensation. And it broadly defines deferred compensation because prior to that code section, we had an IRS revenue ruling 60 31 that we relied on for 40 years as really our only guidance on how to properly design deferred compensation to avoid current taxation and to delay the tax on the funds until they were actually paid out. Well, 409A is very broad, is very strictly enforced, and there's very little ability to remediate problems with a deferred comp arrangement. So we've got very strict rules on the deferred comp, and it applies not just to traditional deferrals, but also to compensation in that can be embedded in things like a stock option. So if a stock option is granted with an exercise price less than fair market value on the date of grant, that creates immediate deferred compensation, which is going to not comply with 409A. The result is we've got to be very, very careful now with valuing uh, equity when we make equity awards to assure that we don't violate 409A. Lastly, before I let the next question come up, is to address the issue of Code Section 82 has long been around dealing with transfers of property, so that's restricted stock tax treatment, and 162M, which is the historical $1 million cap on compensation that says employers that pay their execs more than $1 million in compensation will not be able to deduct the excess. And it used to be that if that comp was considered performance-based compensation, then it was not subject to that limitation. That was eliminated with the 2017 Tax Act, so that now any comp over that million is not deductible by the company. And that 162M was extended to apply to tax exempt employers. So there's a host of regulations now on executive compensation. So it's an area to tread very carefully in.
Well, thank you for that excellent start up to our session. And for those not that familiar with 409A, the American Bar Association has a multi-hundred-page book just on 409A compliance, which has become a subspecialty of many folks in this arena. So thank you. Elizabeth, Andrea talked a little bit about some of the pieces of executive comp, and it sounds like a nebulous term at times. Can you go into a little more detail about executive comp and some of the elements and things that you think the audience should know about these things?
Sure. I like to think about executive compensation in terms of the birth to the death of the relationship, essentially. I mean, when you're looking at incentivizing your key executives, or if you're an executive trying to determine whether you've got the right mix, then you've got to think right off the bat about sign-on bonuses and make-whole payments. wherever that executive left, they probably left behind some equity. They may need to be made whole for that. You likely want to think about some kind of an equity grant, restricted stock grant, or options right off the bat to align the executive from day one with the company. There's also, I mean, we tend not to think about these things, but moving or short-term, long-distance commute allowances are becoming more and more common, where you're finding your talent in North Carolina for your position in California, and they're not ready to move their high schooler mid-year, and they want 6 months of commuting 3 times a week to California, and they're going to need an apartment in California, and commuting expensive, and that's a major part of executive compensation negotiations these days. You've got obviously your base salary, annual incentive. You want to make sure that you've got a mix of short-term and long-term incentives. So you tend to do a quarterly or annual incentive, and then you're going to be looking at your longer-term incentives, stock options, stock grants, RSUs, phantom stock. We used to always call those long-term incentive, and the trend now is actually to call those long-term performance, because more and more companies are finding that instead of just granting equity, they want to tie the compensation to some form of performance. So more and more we're seeing LTI plans become LTP plans, or some mix of LTI and LTP, which is generally a mix is almost always where you want to go. And as Andrea mentioned, deferred compensation is becoming more and more important, because you have a lot of executives who are maxing out traditional retirement, and they're looking to keep their standard of living post-retirement. So they're looking for some kind of deferred compensation, deferred tax options. Then you've got your basic benefits and your enhanced benefits. And these might seem like no-brainers, but they're getting more and more complex due to rules related to cafeteria plans and non-discrimination, depending on how your insurance is funded and how your benefits are funded. So that can be very tricky to create the right kind of top hat plan for your executive, but it does make a difference to executives where they'll go. It's getting a little bit more unusual to see the kind of perks that we saw back in, or I should say that some people, not me, saw back in the 80s with the corporate jet and the club and the club memberships. But for some companies, these are definitely a part of building business, and they're essential to the executives, and some executives are still insisting on that plane. Then when you've got your severance pay and your change of control kickers, where your executive is going to get some kind of a bonus paid out if there's a change of control before they're terminated without cause, or they resign for good reason. And then you want to think about your on your way out transaction bonuses for sale of the company, or a phantom plan that pops if there's a sale of the company. And again, as Andrea mentioned, then restrictive covenants that may not sound like executive compensation. It's a restriction, but frequently there's negotiation regarding, well, is there going to be a different time period imposed if the executive is terminated without cause, or if they meet certain performance metrics, or will maybe their non-compete get restricted? And of course, depending on where you are in the country, the ability to put those restrictive covenants in place has gotten a lot more difficult, particularly, as we all know, California. So when we're looking at these elements, you're always looking to balance your variable versus your fixed compensation, and your discretionary versus your objective. And those are always sort of a push-pull with your executive. But at the end of the day, if you've done your package right, then your executive is going to be aligned with the company, so the company's success is the executive's success. But at the same time, the executive is going to have enough certainty that they're not continually worried about their paycheck. So a lot of elements to throw into the basket there for you.
Well, thank you, Elizabeth. That was great. And yeah, we could probably all tell war stories of especially with, as Andrea said, with the disclosures now of compensation. One quick story, a company that I won't name, the CFO, they were going through a reduction in force, major reorganization of the company. But that individual was getting like a $2 million bonus instead of compensation for a year where a lot of people were let go. A lot of his subordinates, VPs and others were getting kind of the shaft on a lot of this stuff and asked for it to be deferred or restructured. The story goes the company said, no, too bad, right? You have to disclose. It's your money. I remember you mentioned the 80s. My first career was in accounting and I was in the insurance arena. And when Sandy Weil became CEO of Travelers, the story goes that he wanted a fireplace put in his office on like the 39th floor of some building, and they figured out, some skyscraper in New York, and they, I sometimes say that some of the executives have become like rock stars or movie stars, right, with their unique benefit requirements. Neil, this might be a good segue for you to tell us about ways that companies can develop a compensation strategy for an organization, and some of the thought, given that Andrea and Elizabeth have kind of set out a bunch of regulatory issues, as well as how do you come up with a compensation strategy for an organization overall, taking into account all these kind of factors that have been talked about already.
Yeah, thank you, Dan. But there are typically several steps that companies go through. The first is to survey, and there are lots and lots of surveys that are published, some by neutral organizations. Now, of late, the last few years, employees have given data of their own, if you believe it, to certain databases that are also available. But there are lots and lots of surveys. But you need to hone that in terms of several factors typically. Number one is geography. Is this likely to recruit from a national organization or a regional organization or whatever? Secondly is industry. You want to look at the industry that the client is in, company is in, and search out data for companies that are like them in terms of manufacturing or distribution or marketing and perhaps even products. You'd also look at size of organizations. Typically, bigger companies pay their executives more than smaller companies. So you want to look at range of size of revenues that would encompass likely people common ilk that they might recruit from. And that's a major thing. Okay, and then once you've and you might have several cuts of data, if you will, if I can say it that way, of that you would look at, and you have to sort out that and look at what makes sense in terms of competitors and size and geography and those kinds of things. And determine, then the next step is determine what your targeted competitive level that you'd like to achieve. Is it one of median of the market? Is it above market, given performance of the company, perhaps? Is it below market? Is it, for instance, a not-for-profit or something like that that would generally pay less than the ongoing market of ongoing for-profit organizations? After that is you've sorted out, and you likely want to call upon the several publics to get to that composite recommended competitiveness level. I mean by that shareholders, customers perhaps, look at what this would mean to other executives of the likely size of the organization, and also you want to look at perhaps how employees would feel now that they're able to look at the average compensation for a company versus what executives are making. So those things sort out. And when you do that, then you need to come up with the metrics that you're going to measure performance. And that's very much driven by the kind of company. Manufacturing would be different than marketing distribution. And obviously, I've already touched on not-for-profits. That some of those are complex metrics and some are pretty straightforward, such as revenues. The question is how many metrics you want to use, and it would likely vary by also elements of the compensation package. For instance, you might use different metrics for annual incentive plans versus longer incentive plans. Then the final step is one of communications. Certainly the executives, the managers, and with help from human resources, are typically charged with the whole notion of communicating what compensation is to the executives and managers, directors, really, and all employees. And it doesn't just fall on the human resources, but the managers are the number one person that will do the communications. Dan?
Yeah, thank you. And you mentioned you mentioned the ratios and stuff. And again, in 37 years I've been out of college, and I think at one time it was about an 8-to-1 ratio. I think CEO pay versus average employee, and now I think it's 222-to-1 or something like that. Something
like that, yeah.
Some crazy number.
One of the interesting things, Dan, is people thought that would really not, most employees would not like to hear those things, but it turns out to be almost nothing. We haven't heard much in the press at all about employees being disturbed by the difference in the CEO pay to what the average employee is paid.
Yeah, no, that's true. You mentioned there's various approaches to executive compensation, and really two that I want to touch on very briefly. One is the total shareholder return model. Executives are aligned with shareholders. It's rewarding when things are good, penalizing when things go bad. There's an interesting book that was put out years ago by a guy by the name of Alex Bernstein. It's called The Number, that I think is commendable, both for that ratio thing, but also for kind of this total shareholder return and the inherent conflict that the executive C-suite has on incentive-based, whether it's shareholder or accounting-based measures, to hit the number, because as Elizabeth and Andrea talked about, some of the deferred compensation a lot of times with restricted stock grants, with options, with whatever other deferred compensation, incentive comp, performance comp. There's big incentives, the better the numbers look. And so there's, Andrea mentioned Enron and WorldCom. There's so many other companies in the late 1990s with the dot-com bubble, but just in general with a lot of other issues. And so, like I said, one method is the total shareholder return method. And a lot of times the argument against that is that a small percentage can be attributed to management over the course of the year. I said it's a lot like sporting events again. My Chicago Cubs, sadly, hopefully they will win in a couple hours after this is taped and get to Game 4 of that series. But how much does a manager have influence over the players that are making, again, probably 220 times what a manager makes? It's the opposite in baseball. The other way is accounting-based measures, and again, there's a lot of ways to do it, EBITDA and multiples and other earnings per share and other metrics that you can use. Again, each of them has their benefits and downsides, and it's really a matter of, again, the goal, I think, of boards, and especially as we'll get into in a bit, with more activist groups looking at kind of CEO pay and other issues and being very active. It's that performance, as Elizabeth talked about, really aligning long-term performance so that the shareholders make out, the company makes out, it's selling its products, it's making great profits, et cetera. And even for nonprofits, there's even though they're nonprofit, they still have to do well to do good. So let's turn to the next question. Because it's compensation, executive compensation has a lot of tax consequences. And I think, Andrea, you mentioned a few of these before, but what tax rules apply that are specific to executive comp? And I know it's a very complex area.
You're right, it is, Dan. Thanks. As I mentioned at the beginning, I kind of threw these numbers out at you of code sections so that folks would have an understanding that anytime we're looking at compensating someone for services, whether they're an employee as an executive or an outside director, that's going to be a compensation, that's going to be a taxable event. And so we need to make sure that we're compliant with the applicable provisions of the Internal Revenue Code. And for most people, when they think of exec comp, they think of 409A, and that is the deferred compensation. Those are the executive retirement plans that Elizabeth was mentioning, that, we're planning to provide you some type of guaranteed benefit when you leave, or the executive elects to forego a portion of bonus or salary in exchange for the payment of that at termination or retirement. Code section 409A governs that. The rules are very strict on compliance. You mentioned, Dan, that yes, if someone wants to read about it, there's lots of publications on that. And the books are all relatively long and thick. And it's because we've got hundreds of pages of regulations for this one code section. So that's just one item that applies to deferred comp. Then I mentioned the 162M. That's the code section that historically implemented the $1 million cap on comp, with an exception that used to apply for performance-based comp that's now gone. It now extends to compensation paid to employees of tax-exempt employers. This does not apply to for-profit private sector employees. So there is a difference there in who that applies to. There's code section 83 that applies to the transfer of property. And that's where I was talking about the awards of like restricted stock or outright stock grants. Those are taxed under code section 83. You may have all heard of something called making an 83B election. That's where someone gets an award of unvested stock, and they can go ahead and take the value of that award into income in the year of grant, meaning they have no right to it yet. They haven't worked the requisite vesting period to become entitled to it. But if they take the value into income in the year of grant, then later when that vests, assuming the executive remains an employee long enough for it to vest, then there's no tax event. And if upon subsequent disposition, they could be eligible for long-term capital gains treatment. So that's a nice tax savings feature, but of course the executive takes a risk on paying income tax on something that they perhaps may never vest in. Two other code sections or two other Internal Revenue Code provisions that are important to be aware of is Code Section 457 has special rules that apply to deferred compensation of tax exempt employers. So those provisions apply in addition to 409A, not in lieu of, in addition. And so you have to make sure that any deferred comp for the tax exempt employer takes into account both of those code sections. And for those tax exempt employers, they also have to be aware of, as Neil was pointing out, getting those salary comparisons, getting those compensation surveys done. Because you want to make sure, as a board member, anyone who serves on the board or has authority over a tax exempt employer can have personal liability for excessive comp paid to employees of that tax exempt organization. We refer to that as private enormement, meaning the assets of that organization are inuring to the benefit, impermissibly to the benefit of that executive. And so it's very important for people approving the compensation for executives of tax exempts to have a strong basis for that compensation. And that usually comes from surveys or consultants' reports, depending on the size of the organization. So that's just some of the tax rules. I don't want to take up too much time because I know Elizabeth probably is going to have a lot to go over. So thanks, Dan.
Yeah, you mentioned 83B, and every startup person, I've done some incubator work and support in the past. They all know 83B. They have no idea what it means, and they all, like you said, a lot of times, especially in the dot-com bubble, even a lot of attorneys went out west and did like pet.com and got 8 gazillion shares of, paper that was worthless. It was wallpaper, but they paid taxes, on a low price even. It can add up to significant money. So, Elizabeth, there are lots of different metrics by which performance can be measured relative to executive comp. Why don't you go into some detail about what metrics should be used and how does a corporation make that determination amongst these various choices? And for those at home and watching, 24 to 26, those slides are kind of going to be covered somewhat by Elizabeth.
Sure. This is a big question and essentially one of the most important when you're preparing the package for your executive, because if you choose the wrong metric, it should be metrics, then you can really, one, disincentivize the executive or incentivize them in a direction you don't want. So the sort of two things you start with is the basis, how you're going to evaluate this, and then the form. So when you hear people talking about objective versus standard and qualitative versus quantitative, so when you're looking at the basis, then you're either going to be looking at some kind of an objective number, like, oh, you need to hit such and such, it's going to be a specific number, you need to hit it. Or you're going to be looking at a standard, which might be a company standard, or it might be a relative standard, where you're doing some kind of a comparison. Those are generally broader. And then you're going to be looking at qualitative factors and quantitative, hopefully. So your qualitative factors, your metrics, your absolute number based, and then you're going to be looking at company performance, your customer satisfaction, your less objective criteria, which can be even more important. We all know the story of Alcoa, but I'll remind everybody, for those who were born after 2000, Paul O'Neill takes over as CEO of Alcoa in 1987 or so, and he says he's going to make worker safety his #1 priority. And if all the shareholders freak out, everybody assumed that he was going to come in and increase profits, and that his #1 metric was going to be EBITDA, something along those lines. And he said that he was going to make Alcoa the safest company in America. Well, it turned out that that was genius. He did increase safety. Accidents and injuries dropped dramatically. This was a very unsafe industry at the time. Productivity shot through the roof. Worker satisfaction shot through the roof. And that made profits go nuts. So during his tenure, I want to say that market value increased from 3 billion to over 27 billion. Don't quote me on those numbers. And this was a metric based on safety. So choosing the correct metrics for your company is just vital. And you're going to want to look at just choosing one, like safety, is probably not the way you want to go. You're going to want to choose somewhere between 5 to 10 metrics. And you're going to want to make some of them objective, financial, some of them to be potentially subjective, something that the board could control. There needs to be a lot of disclosure, particularly around the subjective elements, so that everybody is clear about what's happening, where you're coming from. You need both short-term and long-term objectives. If all of your metrics are weekly or quarterly or annual, then you are incentivizing your executive to only think about the short term. But from the company's point of view, that long-term goal is really important. This is the problem that Dan, you sort of brought up with the whole, just using TSR and going that way, is that it's so easy to manipulate that number by letting good news come out right at the right moment. And then all of a sudden, shareholder return pops up. Everybody gets excited after the quarterly call. And oh my goodness, the executive has definitely hit his metric. Well, or has she? No, maybe. But that's why you need a mix of long-term and short-term metrics. And you need a balance of financial metrics and non-financial. So your financial metrics, you're looking at like profit margins, return on investment, working capital, revenue growth, cash flow, capital expenditures. I could go on. And your non-financial, that might be, things as nebulous sounding as company culture or relative growth compared to other industries, and your how much return you have from customers. Are you getting the same customers coming back and back and back and back, or do you only have new customers come in because of sales or what have you, and then you're losing customers? Like, all of these are more nebulous. They're harder to make into straight up numbers, but they can be very important metrics. Innovation, business development. So we'd suggest that you balance these, that you don't focus too hard on one. It's tempting. It's very tempting to just say, you increase EBITDA and everybody goes home happy and we're done. But it's not good for the company or the executive long term. If the economy tanks, then the executive might be doing something amazing for the company compared to the rest of the industry. And you don't want to lose that executive. If the whole world is on fire, and so your company is on fire too, but your company's less on fire than everybody else, then reward your executive. And it's a lot easier to do that if you've done this mix of metrics, and if you've done some relative metrics where you are comparing your company's performance to, as Neil mentioned, to some comparison companies, to what's going on in the industry as a whole. Like maybe you choose 15 to 20 other comparable companies, and you say, well, what are the profits going on in all of these companies? And then you compare the performance to that. It needs to be, your metrics should be comprehensive, but absolutely focus on the key drivers for your company. If your company has plenty of gross profits, but the margins are terrible, then don't default to profits. Like, focus your executive on your margins and make that the metric that drives more of the performance-based comp. And again, always a good idea to mix your performance-based comp with your non-performance-based comp, so that there's, if there's a terrible year that's out of the executive's control, let's say that as Dan mentioned, these things take time, and a program that a CEO set up 5 years ago might come to fruition now in either a very good way or a very bad way that's outside your executive's control. And you don't want them to either experience a windfall or to be totally disincentivized to do anything, because no matter what they do, they are not going to be able to hit any of these metrics because of a program they had no control over. So choose several, give the board some subjective control over some of them, and mix them up would be our advice.
I think it was great. And I always think of two examples of how sales can be, if that's the target, as Elizabeth said. One great example in the 2000 timeframe, again, is Sunbeam. I can't remember the guy's last name. The first name was Jim. He was the CEO that said, if you want a friend, get a dog. I have two. Looked like two Dobermans or something. He was down in Florida. He was sending grills to the Midwest, to Wisconsin and Chicago in the middle of November and December, and pre-stocking all that stuff. The other thing that comes to mind is the Seinfeld episode where Costanza's in his garage with his next door neighbor. I can't remember the guy's name, but he was selling computers, and it turned out his phone wasn't hooked up. It was disconnected. And so he was faking. He was ringing the bell every time. The other thing I'll talk about, Alcoa had the safety as its thing. Believe it or not, Enron back in the late 90s, they were Fortune or Forbes, they wanted to cover as the ethical company of the year. They had a zero tolerance policy that I've talked about extensively. I've done a webinar on that alone. It was a multi-page booklet of talked about whistleblowers and stuff. And if anybody's read on Enron, what was being said was tone deaf or deaf in general, because those whistleblowers were disregarded and not paid any attention to while Enron was doing its special purpose vehicles and stuff. I want to quickly talk about two. What's that?
The reason we have 409A today.
Yeah, and Sarbanes-Oxley and Dodd-Frank that I'm going to briefly talk about. That all came about in this kind of time frame because it was seen that the disclosures, and there was no real penalties. Some of the things that Sarbanes-Oxley and the Dodd-Frank Act did, it was already mentioned that the SOX post-Enron ended personal loans to executives, which to me was always a bad idea anyway. Like, why companies would be lending money to people that are making a lot of money already. Talk about bad alignment, you got to pay back those loans. And a lot of them use their stock and other stuff. That's a whole other story. They're always confused about pledges they make to collateralize their condos or other properties. SOX also introduced tighter internal controls. If Y2K, which I worked on extensively, was the IT's one-time grant of power, Sarbanes-Oxley was the accountants and compliance folks, nirvana, because they were able to, they had to hire. Some of the costs of audits went, I think Starbucks about doubled or tripled when Sarbanes-Oxley came out because of all these additional checklists and stuff. And there's faster Form 4 reporting for new additional stocks granted to executives and board members. Dodd-Frank post-crisis added say on pay votes, pay ratio disclosure, mandatory clawbacks. Although clawbacks, I mean, it's there. I'm not sure there's been many clawbacks. It gets very ugly and messy. I don't know how you get the money back. One of the biggest things I think that came out of this is that the compensation committee and advisors have to have independence now, just as the audit committee does. So that there's independence. There's a whole different process than it used to be. It used to be the CEO would go into the boardroom or talk to the compensation committee, audit committee, and say, this is what we're doing. This is our numbers. Now the audit committee hires and the compensation committee does their own studies. They do their own kind of board checking of compensation. So it's much different. So compensation became a governance tool, not just a reward mechanism. And again, all this complicated factors that Elizabeth and Andrea have been talking about. Neil, why don't we talk about pay transparency and that came out of this kind of, but also what that looks like, and can you tell us a little bit about that?
Yes. Pay transparency has, in many ways, started to govern and drive compensation. At the employee level now, when in over 20 states and municipalities, they're required to post salary ranges when they're posting a job, and that's influenced a lot of companies. I believe more than 70% of organizations that even don't have all their operations in a state or a locale where they were required to post salaries have gotten to do that. I have a recent example that I was very surprised at, and the company is Harley Davidson. Harley Davidson is about a $4.5 billion company that produces and markets largely large motorcycles. They've experienced several years of declining sales, mostly because their customers are aged men, and those are, as we know, we are not replacing the youth of aged adults very much, and so they're leading to decline. This has made their dealers very unhappy, and a shareholder group has taken action to nominate their own boards of directors and ask for the CEO to be replaced. Well, the CEO was replaced. He started October 1st. Surprisingly, again, I live in and do consulting in the Milwaukee area, and there's a publication called Milwaukee Business Journal. In September, before the executive took his place, they published at least the outline of his compensation package. Now, that was not driven by legislature. It was driven by just a need to pay transparency. They said what was published was the level of his salary. He was given one-time grants of salary and and equity, likely to replace those that he was walking away from in his prior job, and perhaps also to induce him to take this job. And then finally, it gave also uh, uh, the magnitude of his annual incentive, his possible earnings, and also the long-term earnings that could come from a long-term plan. And I was surprised. I had never seen it before, and it was, I think, an indication of the level of we're walking through pay transparency, not just required in some legal documents on an annual basis after the fact, but this was before the fact. And so that's why I bring up the story.
Thank you. Andrew, there's been a lot of discussion about compensation committees and the crucial role they play in publicly traded companies. Three-part question: what is a compensation committee? Why is it important to the composition of a compensation committee? And what should a compensation committee look like when making determinations? Look at, not like, when making determinations and assessments related to executive comp.
Oh, sorry. I didn't realize I was on mute. Thanks. Well, executive compensation committees, as everyone's been talking about, this is something that I think the focus on it came about as a mandate through regulatory requirements, whether it was from the exchange or the SEC, but now it's becoming a cultural mandate to have these compensation committees for not just companies that are subject to the legal requirements, but also those from a good fiduciary standpoint as board members to have a comp committee. So typically our comp committees are outside directors serve on the comp committee, and by that we mean directors who are not serving as also as officers or otherwise employees of the company. And the comp committee oversees and develops the executive compensation packages. They frequently will utilize independent consultants and advisors. They, the size of the committee, again, is usually determined based on the employer and its size and complexity. You may have a comp committee of 3 people. You may have a comp committee of 7 or 8 people. It really depends upon the function. Elizabeth was very clear in when you're looking at the metrics for valuing an executive's performance, you want to make sure those are tailored to the business. And your comp committee needs, in a similar way, to be tailored to the business, the company, and in its complexity. Oftentimes, that comp committee needs to also, when it's setting the objectives for compensation, especially incentive compensation, it does need to be very mindful of the fact that any single metric is not going to be fairly determinative in whether or not an executive is performing at or beyond, or sometimes below expectations, and that oftentimes there are conditions outside the executive's control that will affect the company's share value, the company's performance. And so it's important to be able to distinguish between what is it that the executive is controlling and or responding to and leading versus what are those conditions that have absolutely no impact or that the executive can have absolutely no impact on. So these committees are important. And if I can say one thing, I think they all need to do more than they probably do now, and that is to document. So if later there's a challenge about whether or not this committee was acting as a rubber stamp or was really carrying out its duties, I say it really helps to document that process.
Excellent advice, and the caution there is always for whoever's documenting that to kind of use the Goldilocks approach, right? You need to just get them right. So you don't want to have too much detail, too much discussion, fine art, and depending on who's the chair of the comp committee, they're going to have different idiosyncrasies about what they want to do. But you're right, Andrew, you have to have all these committees now more and more. You know, when boards get in trouble, it's because they either haven't documented well or there's not evidence that they weren't anything but a rubber stamp. And some of these rules on independence that we talked about earlier are designed to, in some ways, prevent some of that inside baseball from taking place. So we had a lot more questions to cover, and just this hour flew by unbelievably quickly. I want to thank our panelists for the excellent insights and expertise. It's been an honor to be able to be moderator of this great panel. Audience, this concludes our webinar. Thank you for joining another entertaining yet educational production of Financial Poise. Look for Financial Poise webinars wherever better continuing education webinars are sold. With that, go Cubs and take care.
Good.